while the average investor lost 30% of their portfolio in 2023's high-interest massacre. Warren Buffett quietly made $4.8 billion. What he's doing differently isn't what you'd expect. In this video, I'll reveal Warren Buffett's exact playbook for thriving in today's brutal interest rate environment. You'll discover why Buffett actually gets excited when rates are high, and the 3 specific types of companies he's buying right now that most investors are completely overlooking. Plus, I'll show you the shocking truth about which of Buffett's biggest winners were actually bought during periods just like this. But first, let me show you something about interest rates that even Wall Street doesn't understand. Imagine if gravity suddenly doubled. Everything would crash down. That's exactly what happened to the stock market when interest rates shot up. But here's what most people miss. Warren Buffett calls this gravity change, the biggest opportunity of the decade. The fascinating thing about this opportunity is that it creates a natural filtering system, separating truly robust companies from those merely riding the wave of easy money. Let's get real for a second. Interest rates are hovering around 5.5%, the highest since 2007. Everyone's panicking, but Buffett? He's seen this movie before. In the 1980s, rates hit 20%. Yes, 20%, and guess what? That's when he made some of his biggest wins. What's particularly intriguing is how this environment creates a perfect storm for value investors who understand the fundamental difference between price and value. Here's why this matters. Right now, government bonds are paying around 4.5%. That means any company you invest in needs to beat that just to be worth your time. This is what Buffett calls the yardstick, and it's completely transformed how we need to value companies in 2024. The beauty of this yardstick is that it creates a clear mathematical framework for evaluating investment opportunities, something that was much harder to do in the zero interest rate environment. Most investors don't realize that this higher hurdle rate actually makes it easier to identify truly exceptional businesses, not harder. But here's where it gets interesting. While everyone else is running scared, Buffett's looking for what he calls economic castles, not just any companies. Businesses are so powerful, they can raise prices even when consumers are stretched thin. The genius of this approach lies in its simplicity. When interest rates rise, the strong get stronger while the weak get weaker, creating a natural selection process in the market. Think about Coca-Cola. During the 1970s interest rate crisis, their profits kept climbing year after year. Why? Because they had what Buffett calls an unbreachable moat. Their brand was so strong, people kept buying Coke even when money was tight. What's even more remarkable is how this brand moat actually strengthened during tough times, as competitors cut back on advertising and product development. In 2024, these moats look different, but their importance has only grown. The first type is the tech ecosystem moat, exemplified by Apple's iPhone empire. This isn't just about selling phones. It's about creating an entire digital ecosystem that becomes more valuable with each user, making it practically impossible for customers to leave. The network effects in these ecosystems actually accelerate during economic stress, as users become more reliant on integrated services. The second type is the brand fortress, represented by companies like Ferrari and Louis Vuitton. These companies have spent decades building not just products, but desire itself. During high interest rate periods, luxury brands often strengthen their market position because their core customers are less affected by economic headwinds, while aspirational buyers' temporary absence only increases the brand's exclusivity appeal. The third type is the infrastructure monopoly, with Google's search dominance being the perfect example. These companies own the digital highways of the modern economy. Their moats are so wide and deep that even rising interest rates barely make a dent in their competitive position. In fact, these infrastructure players often consolidate their market power during tough times as smaller competitors struggle to maintain their services. Now, here's something Buffett does that almost nobody talks about. He becomes a debt detective. In high interest rates, debt can sink even great companies. The brilliance of this approach is that it combines quantitative analysis with strategic foresight, revealing vulnerabilities that might not be obvious in normal times. The rising rate environment acts like an X-ray machine, exposing financial weaknesses that were hidden during the easy money era. Look at Google. They only paid $94 million in interest last quarter while making $23.7 billion. They're basically bulletproof. This kind of financial fortress doesn't happen by accident. It's the result of deliberate capital allocation decisions made years in advance. The company's massive cash generation ability actually increases their competitive advantage during high interest rate periods, as they can fund growth internally while competitors struggle with expensive debt. But then look at Carnival Cruises. They paid $471 million in interest and only made $276 million total. This isn't just about numbers. It's about strategic flexibility. When a company spends more on interest than they make in profit, they lose the ability to invest in growth, maintain their assets, or respond to competitive threats. The compounding effect of this limitation becomes more severe with each passing quarter. When examining companies through Buffett's debt detective lens, we're looking for organizations with carefully managed debt loads that maintain their strategic flexibility. These companies typically maintain conservative debt to equity ratios that keep their interest payments manageable even if rates rise further. They've built substantial cash positions that serve as both a safety net and a strategic weapon, allowing them to pounce on opportunities when competitors are constrained. But wait, there's something even more fascinating that most investors miss completely. I've analyzed every major purchase Buffett made during high interest periods, and I found something shocking. His biggest winners, companies that returned 1,000% or more, were all bought when interest rates were above 5%. Why? Because high rates scared away other investors, letting Buffett buy great companies at discount prices. Here's the data nobody else is talking about. Companies with strong moats actually increase their market dominance during high interest periods. While their weaker competitors struggle with debt payments, these companies use their cash positions to grab market share. Remember how we started this video talking about Buffett making billions while others lost money? Now, you know his secret playbook. Use high rates as a bargain hunting opportunity. Focus on companies with unbreachable moats. Analyze debt positions like a detective. Look for market leaders who can raise prices. Ignore short-term interest rate panic. Here's what makes this moment truly special. We're living through exactly the kind of market conditions where Buffett made his fortune. As he famously said, "The best time to buy stocks in recent years has been when interest rates were sky high." Hit subscribe and turn on notifications. Next week, I'm sharing the exact checklist I use to find companies that meet Buffett's criteria in today's market. Drop a comment below with Moat if you want me to analyze a specific company in that video. Remember, while others see high interest rates as a threat, Buffett sees them as an opportunity.